Hi, everyone. Welcome to Refinitiv LPC's Middle Market Weekly. I'm Dave Puchowski, Director of Market Analysis. We're changing up the format of our Middle Market Weeklies to not just include our usual data updates via PowerPoint, but to offer more timelier color given the current state of the market and the impact of COVID-19. So expect to see more audio recorded PowerPoints and interviews and video casts from the middle market team here in the coming months. We hope you'll enjoy it. This week, we're going to touch on the sponsored market, but first, let's get you caught up to speed on some things going on in the secondary market currently. The chart on the left shows historical bids for both the LPC 100, which is our 100 most liquid loans cohort, and that's coupled with middle market bids. You can see that the floor that was hit in late March did not reach the same levels as in 2008. And I'll talk a little bit more about that in a minute. On the right is the same data, but with BDC visible loans added and just since the beginning of the year, so we can see the more recent trends highlighted there. Of course, liquid loan bids are going to swing more dramatically than less liquid names, and you can see that with the LPC 100 now trading near the 90 context after dropping as low as 78 in late March. One of our reporters put up a story on these print and sprint short-dated CLOs today. Those are being formed to take advantage of the sell-off in the secondary market. Blackstone GSO formed one, and Palmer Square is now looking to raise one. So we'll keep an eye on that. Another, contingency out there that's taking advantage of the current sell-offs in the market. Meanwhile, the more illiquid loans in the middle market and BDC cohorts there, those bids have been somewhat flat since late March. Now, maybe we've seen the floor already, or maybe not, but one reason that the most recent floor may not be as low as in the past is because of second lien loans, or the lack thereof in today's market when compared to the last crisis. If we look on our next slide here, second lien loan bids don't appear to have found their floor yet. The overall market cohort of second lien loans did trade higher earlier this week to the 66.7 area. But certainly we haven't seen bids bounce here like they have for less riskier loans. Middle market second liens, meanwhile, are bid around the 75.3 context. But that middle market cohort is much smaller today than it was in the past. Currently, it only comprises 56 names, which at the start of 2018 was as many as 86 names. I couldn't look further back than 2018, or else I would have, but we can go back further if we look at primary market issuance. In the chart on the right, I've circled the amount of middle market second lien volume in the lead up to the 2008 recession. And you can see there was just a lot more second liens in the system back then. Now, last year, we only saw around $1 billion of syndicated second lien volume in the middle market. Much of it gets privately placed now. By contrast, in 2007, there was over $9 billion in middle market second lien volume. So that's at least one reason we didn't see bids drop as far during last month's free fall in the secondary market. Looking at loan bids by sector, this is for the entire market. We see some of the industries that fell pretty hard last month and where they recovered to. Interesting that retail has seen a little bit better of a bounce than some others like restaurants and leisure. And then see oil and gas bids there, the yellow line, which has not recovered much, only slightly, and obviously more pain being felt there due to lower oil prices. On the right, I charted the middle market bids by sector. That's looking at them now compared to January, and thought it was interesting to see healthcare fall that far, but a lot of it was due to one name, Jordan's Healthcare, which dropped below the 50 level, so that's one culprit bringing that average down. Now, this is from our investor survey report that we released recently, and I'm using it again because it fits well here, but we asked middle market lenders where they thought the impacts would be felt by COVID-19, and here's what they responded. You see the positive impacts on the left there. I thought online learning was a good one. Some things we really don't know until we take a plunge, and the social distancing and quarantining has certainly plunged us into online education. I'm wondering if one of the longer term takeaways from this time period will be a change in online education. Here's a list of middle market loans whose bids have been impacted the most since late February on the left. Certainly look at some of the sectors. These are not surprising, with a fair share of them in oil and gas, leisure, transportation, aerospace. And you see Miller's Ale House there, a restaurant business, dropping to 65 more recently from 94 in February. They were downgraded to triple C by Moody's in late March. Of course, not all loans have been hit as hard. And on the right, I've shown some of the names that have not decreased as much. API Heat Transfer, the top one listed there, actually has increased, but they started out very low back in February at 74. Now, a few lenders we spoke to recently agreed that things are going to get worse before they get better. More downgrades are expected, and earnings have to come out. So a lot still needs to be played out here. So that's some of the things going on in the secondary market. Shifting over to what we've been seeing in the sponsored market, syndicated sponsored middle market volume totaled only 10 billion in 1Q20, the lowest 1Q since 2016, and only 77 deals took place in 1Q20, which was the lowest since 1Q10. Not much happened in March. Deals that were in market cleared, but then the market paused, and now not much sponsored lending is expected to happen in 2Q20. Lenders told us recently they would be willing to lend in the sponsored market, but only to a portfolio name and only for the right price. And finding that price discovery right now is the hard part. There were a few deals launched this week in the broadly syndicated market, both in troubled sectors and for liquidity purposes. And I believe they're non-sponsored deals. Those two deals are being marketed in the 1,200 to 1,250 basis point area. Spreads on institutional sponsored middle market deals. This chart, you don't see much COVID impact yet there, as the headline suggests. There were two deals priced in March within this data set, Aptos and Cook and Boardman, and they were both higher, 550 to 575 area. But so were their prior deals, and these deals were launched prior to the market locking up. So I'm not sure there's a lot to glean there. This again was from our investor survey from lenders we talked to at the end of March, and where they thought they'd have a first lien spread minimum for sponsored deals. The bulk of direct lenders said 500 to 525, and that's a shift from earlier in the year where the bulk were saying 450 to 475. Bank lenders on the right there, they were around 300, 375 earlier in the year. Now say anywhere between 400 and 525. That second little circle there kind of highlights 25% said 450 to 475, while another 25% said 500 to 525. Looking at sponsored new money, momentum was slow to build earlier in the year, and then the pandemic killed any that had built up since. So we had a very low quarter in terms of volume, and not much is expected in the way of M&A in the near-term future. Dividend recaps are off the table, so we expect to see very low volumes in 2Q20 in new money for sponsored deals. Here's a look at LBO volume. You can see 2Q19 was on par with 1Q19, but if you remember, that was a very slow quarter for activity, 1Q19. And what happens now to the LBO market, where you can't accurately value or project in this type of environment? On the right is charted the average size LBO loan in the syndicated middle market. And I like this chart because you can see ever since around 2017 where that average is now in the $150 to $200 million range compared to historical, where it was lower. And that's due to direct lenders taking more market share away at the lower end of the middle market. Here we see leverage levels on LBO deals in 1Q20. On the left, institutional middle market, and on the right, large corporate LBOs. There were not many institutional middle market LBOs where we track leverage in 1Q20, unfortunately. It's been fewer and fewer each quarter, it seems, as many sponsors go the direct lending route. But when we take the average over the last 2 quarters, it was around 6 times leverage on these deals. Large corporate LBOs on the right there was around 6.5 times total leverage for the second straight quarter. It'll be interesting to see where these averages land after the LBO market opens up more broadly again. Here we have, we're showing the share of rated loans, and there's a lesser share of B3 names that were in the overall LBO volumes over the last 4 quarters. Investors were already showing more risk-off behavior recently. A greater share of deals on the right there. You can see we're leveraged 6 times and 7 times in 1Q20, and by and large, that's because there's more defensive names being LBO'd, including a lot of tech deals, which tend to have higher leverage than other sectors. That's it for this week's recap. Check out the full Middle Market Weekly report on Loan Connector, and see you next week, where we'll be taking a look at the non-sponsored end of the middle market. Stay safe, everybody. Thanks.